Welcome back to the deep dive. Today we are setting aside the elementary discussions of market access.
Right.
We're focusing squarely on the operational mechanics and really the sophisticated portfolio engineering that underpins structured products.
Exactly.
Our mission today is not to define what certificates and covered warrants are. I think our audience knows that.
Yeah.
It's to analyze them as, let's say, surgical instruments for tactical portfolio management. Particularly in these complex areas of risk arbitrage and this is the big one, loss recovery. We are diving deep into the plumbing.
Indeed. We are moving past the glossy prospectus and right onto the pricing desk into the risk management suite.
And our sources for this, they're grounded in the context of Borsa Italiana and associations like ACPI.
Yes, the Italian Association of Certificates and Investment Products, they provide a fantastic, really granular look at these tools.
And I think it's important to say, while the legal framework there is Italian, the financial engineering concepts we're about to discuss, they're universal.
Oh, absolutely. But the tactical implications, especially around, say, tax efficiency and managing issuer risk, they demand sharp scrutiny from any professional, anywhere in the world.
Okay, so let's unpack that core architectural distinction right at the top. I think the first step in really using these effectively is understanding the structural DNA. Certificates versus covered warrants. What is the fundamental difference, both structurally and operationally, that drives how you would use them?
The difference, it's really rooted in their legal form and, by extension, their inherent risk profile. So certificates are quoted instruments.
Which makes them highly accessible.
Very easily traded without the need for specialized derivatives account openings. Structurally, however, and this is the key, they are typically emitted by banking institutions as notes.
So short-term bonds.
Specifically, yes.
Yeah.
A debt instrument wrapped around an equity-like payoff.
Okay, so then covered warrants are different.
Completely. Covered warrants are, in essence, securitized options. They're issued by banks or their affiliates, a market maker like Goldman Sachs or Hull Trading.
And they reference assets that are already trading.
Exactly. So they grant the holder a right, not the obligation, to buy or sell an underlying. They are a pure options vehicle. A certificate is more of a hybrid debt and option instrument.
That structural difference, the certificate being essentially an unsecured short-term bond, that brings us immediately to what has to be the most crucial non-market risk.
The one you can't hedge away with the Greeks.
Exactly. We're talking about issuer risk. If these are debt instruments, what specific exposure to the issuer's credit does the certificate introduce? And why is this so often overlooked?
That's the critical analytical requirement right there. Less sophisticated investors, they often just view certificates as being linked to the underlying asset. They completely ignore the counterparty risk.
But legally?
Legally, certificates are considered equivalent to unsecured senior bonds. It means the investor assumes the full credit risk of the issuing institution. So if the issuer, the bank, were to face insolvency or failure or some kind of resolution action,
the investor is in line with other senior bondholders.
Correct. And they bear the full risk of loss on the certificate's principal, no matter how well the underlying asset performed.
So you're implicitly taking a short position on the issuer's credit spread every single time you buy a certificate.
That's a perfect way to put it.
For a product that's often designed to be defensive against market moves, that introduces a pretty profound vulnerability.
It does. It means that a rigorous credit analysis of the issuing bank, their capitalization, their credit ratings, it's not a secondary consideration.
It's integral to the product's true pricing and risk assessment.
Absolutely. The investor is exposed to a dual risk, the standard market risk, so your beta and volatility exposure, and this non-market, almost binary risk of an issuer default.
That dual risk requirement is what separates, I think, sophisticated utilization from just speculative retail buying.
It is. The operational implication is that the structural arbitrage of the certificate, its, superior payoff profile, it has to be assessed against the inherent cost of that credit risk premium the investor is taking on.
That frames the necessary complexity perfectly. Now let's move into the construction phase. The sheer variety of certificates can often confuse people, but the ACPI categories, they provide an excellent map for payoff profiles.
They do, especially for the capital-protected structures.
And this categorization, it helps us understand the designer's intent, right?
The ACPI map clearly categorizes these capital-protected structures, the ones aiming to return principal at expiry based on their primary objective and payoff. Understanding these distinctions allows an advisor to match the product structure to a specific volatility expectation.
Okay, let's start with certificates digitally. What specific market scenario are they really optimized for, and what are the trade-offs in their engineering?
Digital certificates are fundamentally designed for scenarios where you expect a moderate rise in the underlying. Their key utility is to obtain periodic defined premiums.
Okay, so predictable income.
Exactly. And the structural trade-off is very clear. The payoff is capped, a limit is set on the upside. But in return, they offer full capital protection at expiry, usually up to 100%.
And the premium is conditional.
Right. The periodic premium is only paid if the underlying price meets a fixed level on the observation dates. This is the instrument you favor when certainty of modest defined income is prioritized over, say, uncapped growth.
You're sacrificing high vega exposure for fixed premium reliability.
You've got it.
So let's contrast that strategy with the equity protection certificates. If I'm willing to give up that periodic coupon stream, what upside do I gain with equity protection?
Equity protection certificates focus less on the fixed income aspect and more on obtaining capital returns linked to the underlying's rise, but still with that critical capital protection.
So less cap on the upside.
Right. Unlike the digital type, which has a strict cap, equity protection certificates typically feature a percentage participation in the underlying's rise.
It's more of a traditional equity-like upside.
It is, though it's usually limited by a cap or a participation rate, but it gives you that upside while still providing a robust buffer against depreciation. This structure really appeals when an advisor expects a strong, sustained, maybe non-volatile appreciation in the underlying.
And finally, the structure is built for stability or maybe recovery. Express protection certificates. These seem engineered for the dynamic environment we might see after a market shock.
That's precisely their utility. Express protection certificates are engineered for scenarios of moderate rise, market stability, or even moderate falls where you expect an eventual recovery.
And their defining feature is the early redemption.
Yes, auto-callability. They aim for early redemption at a prefixed amount, and often they'll incorporate a memory feature that recovers any previously unpaid coupons.
So these are attractive when you anticipate the underlying just stabilizing.
Stabilizing or recovering modestly, yes. It allows you to exit the product early with a fixed defined profit, which compresses the time horizon needed to meet your investment objective, all while retaining that defined level of capital protection.
So to summarize, we have structures for capped defined income, the digitally. You have structures for capital appreciation with protection, equity protection.
Right.
And then structures for a defined path recovery or an early exit, the express protection.
That's a great summary.
This brings us neatly to market dynamics. Our data, which spans from 2010 through 2021 on the top 3 conditional capital protection payoffs, cash collect, express, and bonus, it shows a massive shift in what investors prefer.
The historical trend reveals a profound structural evolution in investor demand. There's a clear move away from structures that emphasize maximum volatility capture towards those that prioritize reliable periodic cash flow.
Let's look at the numbers. Early in that decade, express certificates were dominant.
They were. They peaked at around 79% of placed volume back in 2013. This really reflected a market that was seeking a fast resolution, that auto-callability, after some very volatile periods.
But that changed very quickly. What caused the dominance of the cash collect structures? They started at around 2% in 2010 and soared to almost 50% by 2021.
The causality is really the prolonged low interest rate environment post-2008, coupled with, relatively mild market volatility.
Investors were starved for yield.
Structurally starved for yield. Cash collect structures provided that defined risk exposure and, crucially, predictable periodic income streams. They behave a lot like highly attractive fixed income instruments, but with an embedded equity volatility kicker.
So they're monetizing time decay and the low probability of a catastrophic drop.
Exactly. They monetize theta and the low probability of the barrier being breached. The high market share of 48% in 2021 shows that the market structurally preferred a predictable coupon stream over some aggressive, uncapped upside participation during that decade.
And what about the volatility we see in the bonus instrument category? Share peaked pretty high, but then crashed sharply. What does that tell us about its utility?
The bonus payoff profile is extremely sensitive to very specific market expectations. They provide enhanced returns up to a maximum level, but only if a deep barrier is never breached.
So very conditional.
Very. The volatility in their placement peaking near 33% and then crashing to 4% suggests they are highly contingent on short-lived market conditions where investors simultaneously expect high but limited upside and a low probability of a catastrophic event.
They're aggressive instruments.
Very aggressive. And investor appetite for that specific risk profile is highly cyclical. So analyzing these market flows really confirms that the priority for investors shifted from maximizing gain, which was the bonus, or minimizing duration, the express, to maximizing stable recurring yield, the cash collect.
Speaking of structure, let's pivot to one of the most significant recent innovations. This one seems driven not by investor demand, but by market stress.
All right.
I'm talking about the rise of decrement indices. What happened in 2020 and 2021 with corporate dividends that forced structures to fundamentally change their operational approach?
Well, the sharp reduction, or in some cases outright cancellation, of corporate dividends across major indices during 2020, driven by the pandemic, it instantly threw a wrench into the established pricing models for certificates.
Oh, so?
Structures utilize anticipated dividend income. The premium generated by selling that future dividend stream is what they use to finance the expensive options embedded in the certificates, the capital protection barriers and those generous coupons.
So when that dividend stream became uncertain, the pricing desk suddenly faced unmanageable hedging risk.
Correct. The cancellations forced structurers to be significantly more cautious about their long-term dividend estimates. They essentially had to widen the uncertainty bandwidth, which increases the cost of the embedded option.
So the operational implication was stark.
It was. Less dividend income was available for structuring. This resulted in worse product characteristics, lower coupons, less defensive barriers, or reduced protection levels, all else being equal.
Yeah.
The cost of hedging dividend uncertainty just increased dramatically.
So the response was to create a synthetic fix. Tell us about the adoption of decrement indices. How exactly do they function to solve the structure's hedging problem?
Decrement indices are the elegant, albeit costly for the investor, operational response. They are synthetic underlyings, where a fixed amount is theoretically deducted from the index's performance every single day.
Regardless of whether the companies actually pay a dividend?
Regardless. This fixed amount, often expressed as a daily percentage deduction, say 50 or 60 basis points annually, is just factored in.
So let me get this straight. If the real index yields 3% in physical dividends, but the decrement index mechanically deducts 5%, the investor is synthetically underperforming the physical index by 2% a year, just to fix the certainty of that dividend input.
That is exactly right. The fixed deduction simplifies the hedging process immensely for the issuer. They no longer have to rely on volatile, subjective, long-term estimates of future dividends.
They have a known quantity.
A known, predictable decrement built right into the index's mechanics. It makes it far easier to price and manage the risk of the short options embedded in the certificate. This basically transfers the dividend uncertainty risk away from the issuer's balance sheet and fixes it into the investor's performance profile.
So the investor has to be aware that their underlying is now synthetically underperforming the physical index by that fixed amount.
Yes. They're essentially paying an implicit annual fee for the structure's certainty.
That's a crucial insight. The investor is buying structural certainty, but they're paying for it with potential future capital appreciation. Now, let's transition from structure to sensitivity. Let's move into the essential metrics for pricing and risk management, the Greeks. But first, we need to ground this discussion in the inherent non-smooth nature of volatility itself.
Volatility is the core input, and its behavior violates a lot of assumptions of the simple models. When you're pricing certificates and warrants, 3 characteristics have to be top of mind.
Okay, what's the first one?
First is asymmetry. Prices react very strongly, falling swiftly during periods of high volatility, but they climb much more cautiously when volatility is low. This points to a non-normal distribution in returns.
And second, the pattern itself is clustered. We can see this historically just by looking at the VIX index charts. You get those short, sharp spikes of panic and then long stretches of calm.
Correct. Clustering means volatility occurs in bursts. Periods of low vol alternate with shorter, more intense periods where it's high. And critically, these high volatility periods tend to be of shorter duration than the calmer periods.
An analyst has to factor in that short, high-risk window when they're assessing the viability of a barrier.
They do. And the third characteristic, mean reversion, gives us some hope for long-term predictability.
How so?
Volatility isn't infinitely expansive. It has an historical average, and even after these spikes, it tends to gravitate back toward that mean level over time. Understanding these characteristics really informs the selection of the probability distribution you use in pricing models.
If you get the volatility input wrong, your pricing, and therefore your tactical strategy, is flawed from the start.
Flawed from the very start.
Let's leverage these observations now and break down the core sensitivities. The Greeks are dynamic indicators, essential because the option premium is simultaneously affected by so many variables.
That's right. The underlying price, the strike, residual life, interest rates, dividends, implied volatility, it all matters.
Let's start with the first derivative, delta, the measure of price sensitivity.
Delta measures the change in the warrant or certificate price that results from a 1-unit change in the underlying price. For a call warrant, delta ranges from 0 to +1. For a put, it's 0 to -1.
Operationally, why is calculating the delta so paramount, both for the issuer's risk manager and for the sophisticated investor who's executing a hedge?
Because it is, by definition, the hedge ratio. If a warrant has a delta of 0.8, it means that for every dollar the underlying moves, the option moves 80 cents.
So deep in the money warrants will have a delta near 1.
Almost exactly 1. They track the underlying nearly 1-to-1, which makes the warrant a highly leveraged substitute for the stock itself. Conversely, for far out-of-the-money options, delta is near 0.
So knowing the delta allows you to calculate exactly how much you need to hedge.
Exactly. The issuer, or an investor doing dynamic hedging, knows precisely how much of the underlying asset or an equivalent option is needed to offset the risk of their current position. It's your instantaneous risk exposure measurement.
Okay, moving on to the second derivative, gamma. This is where the nonlinearity of the option payoff really shows its face, and where transaction costs start to become a real concern.
Gamma measures the rate of change of delta itself, so how quickly your hedge ratio changes. It's always positive for both calls and puts.
High gamma means delta is highly sensitive to price changes.
Extremely sensitive. And where is gamma maximized? For at-the-money warrants, right where the price movement determines whether the option expires worthless or valuable.
We'll see later in our hedging strategy section how a small change in delta can require a huge change in the number of puts you need. What's the direct operational implication of high gamma for that dynamic hedge strategy?
High gamma demands more frequent and more aggressive rebalancing. You can think of gamma as the cost of constant portfolio maintenance.
A high-maintenance pet.
Exactly. It needs feeding, that is, trading every time the market twitches. If you're delta hedged and gamma is high, a small underlying move forces a large and potentially costly adjustment to maintain your neutrality.
And the opposite is true for low gamma positions.
Right. Low gamma positions, so deep in the money or far out of the money, they require much less frequent rebalancing, which translates directly into lower transaction costs and reduced slippage.
Next, let's talk about theta, the progressive decline in time value. Time decay is usually the enemy of the option holder.
Usually. Theta measures the erosion of values simply due to the passage of time. For standard covered warrants plain vanilla options, theta is negative. The value just diminishes as the expiration date approaches.
And its highest for at-the-money options.
Peak theta is for at-the-money, yes, because they have the maximum extrinsic, or time, value to lose. If an option is way out of the money or deep in the money, most of its value is intrinsic, so it's less sensitive to theta.
But, and this is crucial for our audience, the calculus flips when we analyze specific structured products, like discount certificates or BLOC structures. Why does the overall structure value increase over time for these products?
That's a critical contrast, and it's all because of the embedded short option. For these specific certificate structures, the investor is essentially long the underlying, but they've sold or written a short call option on it at a higher strike price.
So since the investor is the seller of that embedded call, they benefit from its time decay.
Exactly. As theta erodes the value of that short call, the value of the composite structure, the long stock plus the sold option, it actually increases over time. This positive net theta decay is what makes them so suitable for investors who prioritize yield or define returns over extended stable holding periods.
Let's discuss Vega, the sensitivity to implied volatility. In a world defined by this volatility clustering we talked about, Vega is a key risk indicator.
A huge one. Vega measures the change in the option premium for a 1% change in implied volatility. It's always positive for both calls and puts. High Vega implies that the price of the warrant is heavily reliant on market expectations of future movement.
And like gamma and theta, Vega is maximized for at-the-money warrants.
Correct.
What's the direct operational warning associated with a high Vega position, particularly for those out-of-the-money warrants that are used for high-leverage speculation?
The warning is clear, and it can lead to very rapid capital destruction. A significant unexpected drop in implied volatility, say, an unexpected calming of market conditions, can cause a relevant price reduction in the warrant, especially for out-of-the-money options.
Why is that?
because the high leverage embedded in OTM options depends almost entirely on the anticipation of large future movements. If that anticipation vanishes, the vega premium just evaporates. The option's value plunges, even if the underlying price hasn't moved against you yet.
You realize losses simply because the fear or the excitement drained out of the market.
That's it.
Finally, let's address Rho, sensitivity to interest rates. Given the recent global rate environment, Rho has become highly relevant again.
It has. Rho measures the warrant's value change relative to fluctuations in interest rates, which is essentially the cost of carry component. The effects are asymmetrical.
Okay, explain that.
Higher financing costs increase the premium of a call warrant, making Rho positive for calls. The logic is that holding a call option defers the need to purchase the underlying, and that deferred cost is more valuable when rates are high.
And for puts?
Conversely, for put warrants, if interest rates increase, the issuer benefits from higher interest income on the capital they reserve to cover the position. That allows them to sell the put at a lower price.
Oh.
So Rho is negative for puts.
This detailed analysis of the Greeks provides the theoretical framework. Now let's dive into the practical application. Let's move into tactical strategies for hedging, and most critically, for strategic portfolio recovery.
We can start with hedging strategies using covered warrants and distinguish clearly between the cost and the complexity of the static versus the dynamic approach.
Describe the simplest approach, the protective put, or static hedging. Why is the calculation of the hedge ratio so critical here?
Static hedging is basically buying insurance. You're buying a put warrant to protect an existing equity portfolio against market falls while retaining the full upside. The operational challenge is just sizing the position correctly.
Using the index value and the conversion ratio.
Right, and assuming a one-to-one risk movement. Let's use the sources calculation. An investor holds an equity portfolio valued at 65,000 Jurds, and the Euro Stock X50 index is at 6,500 points. The put warrant has a conversion ratio of 100 to 1.
Okay, so if the index drops 10%, the portfolio theoretically drops by 6,500 points. We need the put warrant to gain that same amount.
Precisely. So
Right.
we normalize the portfolio value, 65,000, by the index value, 6,500 points, which gives us 10 units of the index. We multiply that by the conversion ratio, 100, to get the number of puts needed for static coverage.
Which is 1,000 puts.
1,000 puts. If the warrant costs, say, 2,050 each, the coverage cost is $2,500. The key takeaway for static hedging is that this $2,500 is your guaranteed maximum loss floor, but it's also your guaranteed cost no matter what the market does. It's paid premium.
Now let's move to dynamic hedging, or delta hedging. This is where we apply the Greeks we just discussed. It increases complexity, but it also gains precision. How does delta hedging fundamentally differ?
Dynamic hedging requires you to continuously adjust the number of puts you hold based on the delta value to maintain a near-perfect risk balance. So we use the same portfolio, but now we acknowledge that the put warrant may not track the underlying one-to-one.
Okay, let's assume the delta of that put warrant is, say, -0.4. 0.4. It only captures 40% of the movement.
Our previous calculation required 1,000 puts, assuming 100% movement. If the movement is only 40%, you have to scale up the number of puts accordingly.
It scales up dramatically.
It does. The calculation is 100% divided by the delta, then multiplied by the original static position. So 1.0 divided by 0.4 times the original 1,000 puts means you now need 2,500 puts to maintain neutrality.
That's a 250% increase in notional size.
Just to account for the fact that the put only moves at 40% of the speed of the underlying.
So the core trade-off here, which is essential for the practitioner, is transaction costs versus precision.
That's the whole game. Dynamic hedging offers superior instantaneous coverage because it accounts for the actual sensitivity of the option price, its delta. However, it's fundamentally constrained by transaction costs and, critically, time decay, theta.
Every small move requires a trade to rebalance.
Yes, and that's a constant commission drain, plus potential slippage. Static hedging is cheaper to implement, but it's less precise. Dynamic hedging is precise, but can be far more expensive over the life of the hedge, especially in a high gamma environment.
Let's turn to the most tactical and, I think, strategic application in our source material. The recovery strategy for distressed equity positions. The premise here is that just holding and waiting might not be enough to break even.
That's right, because the required hurdle rate is just too high. This is a strategy for positions in what you'd call net suffering or severe loss.
If a stock drops 60%, It needs a 150% gain just to get back to where you started.
And the time horizon or the volatility needed for that 150% rebound is often just impractical. We need structured products to provide asymmetric exposure selling volatility and time to accelerate that recovery path.
Which certificates are best suited for this kind of switch?
The ideal candidates are recovery certificates, and typically they are exotic options featuring European barriers.
The European noture is key.
It's critical. The barrier is only checked once at expiry, which provides maximum safety during the instrument's life. If the barrier were American, it could be breached at any time, which would instantly destroy the capital protection feature.
And what are the criteria for making this kind of switch?
The general criteria are straightforward, but they demand cold, hard calculation. First, you determine the performance needed to recover your initial average cost, your PMC.
Like our 60% loss requiring a 125% recovery.
Right. Second, you meticulously scan the secondary market for a suitable certificate. It has to be linked to the exact same underlying or a highly correlated one that offers a more defensible payoff profile.
And third,
You have to leverage time. Extending the expiration date increases the potential yield and often allows for a reduction in the triggering level required.
the guiding principle is to de-risk.
Exactly. Recover significant losses in gradual steps using defined coupon streams, rather than aiming for one massive high-risk speculative recovery.
Let's analyze a deep loss scenario using the source's E&I case example to show this calculation in practice.
In the E&I deep loss scenario, the position had a P&L of negative 49.52%. The required performance just to recover the initial average cost was a staggering 98.90%.
And just waiting for that kind of appreciation could take years.
Based on historical volatility, that 98.10% needed for recovery might have an estimated time horizon of 5, maybe 7 years. The switch involved moving to a cash collect memory certificate expiring in March 2025 with a 70% European barrier.
Okay, so the switch functionally replaced that near impossible hurdle of 98.10% capital appreciation with what mechanism?
It replaced the single stock risk with a stream of fixed annual premiums of 5.05% and the possibility of auto-callability. The structure basically monetizes stability or minor recovery rather than requiring an immediate, aggressive, parabolic rebound.
So this switch dramatically compresses the time horizon for full capital recovery.
It does because the fixed coupons contribute defined gains year on year, regardless of whether the stock moves 98% or just 5%. The structure is essentially selling the tail risk, that deep barrier to buy time and generate yield.
Next, let's review the AXA case. This one illustrates a more moderate loss, but more interestingly, it highlights a specific dividend arbitrage opportunity.
Yes. Here, the P&L was a moderate minus 9.06%, which required a 9.96% recovery of the PMC. The investor switched to a cash collect memory certificate, expiring May 2025, with a 70% European barrier.
And the key financial data point here.
It's the potential final return of 41.78% at maturity, even if the underlying price remains flat or drops up to 31.18% before hitting that barrier.
Wow. That 41.78% final yield, secured against a one-third drop, that is the structural edge we're looking for. What's the operational trade-off the investor makes here regarding the stock's dividend stream?
They're executing a dividend arbitrage. By selling the AXA stock, the investor forgoes the estimated dividends they would have received until 2025.
But they replace that uncertain income.
Exactly. They replace that estimated uncertain dividend income with a highly defensive, accelerated recovery mechanism powered by the certificate's option payoffs. The structured yield provides a guaranteed net return that more than recovers the initial loss and offers substantial yield, with significantly greater downside protection.
It's the sophisticated choice for an investor who prioritizes certainty of yield over the uncertainty of corporate dividend policy.
Precisely.
We also have an example that shows the power of diversification via a basket structure. The switch from a deep loss in Unicredit. Why use a basket to recover a single stock loss?
The initial Unicredit position required a recovery of 57.21% just to reach the PMC. The tactical switch involved moving to an express certificate with an airbag structure linked to a basket of stocks where Unicredit was a component.
Okay, and that specific product.
The product chosen had a cash collect feature paying quarterly premiums of 1.5% and a high potential return of 57.38% if the 70% barrier wasn't breached.
This introduces the crucial element, diversification within a recovery strategy.
It does. Switching to a basket means the certificate's performance is defined by the worst performing underlying in that basket relative to its specific barrier and strike.
And that accelerates the path to break even.
It can, compared to waiting for the single distressed stock to appreciate. The premium paid out by the basket is essentially harvesting volatility and time decay across multiple components. You're betting that the overall basket volatility, combined with the structural defenses of the airbag and the auto-call feature, will provide a smoother, faster path to recovery than the pure high-risk path of the single stock.
This tactical value, as powerful as it is significantly amplified by local regulation. We need to explicitly address the Italian jurisdictional advantage related to capital gains and losses. This seems to be the primary engine driving the appeal of the recovery strategy.
The tax efficiency is paramount. It transforms capital losses from a sunk cost into a monetizable asset. Under Italian tax law, Art 967, Comma 1, all financial flows generated by certificates, premiums, coupons, gains are uniformly classified as redditi diversi, other income.
And they're subject to a flat 26% capital gains tax.
Yes.
Why is this single classification such a strategic goldmine for loss recovery?
Because the classification as redditi diversi permits positive and negative differentials, gains and losses, to be offset against each other. So if an investor has significant realized capital losses, minusvalenze, from selling distressed stocks, those losses are redditi diversi losses.
And the positive gains from the certificate.
The positive gains, the coupons, and capital appreciation can then be used to extinguish those past losses up to a 4-year window.
Let's put a number on that. If a client has 50,000 euros in carried losses that are expiring this year, and they generate 50,000 in coupon income from a certificate.
That 50,000 of gains is effectively tax-free. It creates a direct, non-market related benefit.
That's a direct, quantifiable 26% tax-free yield up to the limit of the loss carry forward.
Precisely. So certificates become critical, fungible instruments for capital loss recovery. They transform realized losses into an asset that can be tactically monetized. The tax treatment turns these esoteric structures into highly practical, high-value, year-end portfolio cleaning tools.
The urgency of the switch is often driven just as much by the time horizon of the available tax loss as it is by the market expectation for the underlying.
That's often the case, yes.
This ties the entire strategy together, confirming that the structural complexity is strategically deployed to capture both market inefficiency and regulatory efficiency simultaneously. Let's summarize the key analytical takeaways from our deep dive.
I think the first is the critical importance of incorporating a dual risk model into your valuation. Investors and analysts must incorporate both the issuer credit risk, given the senior unsecured bond structure, and the dynamic market risk components defined by the Greeks.
Neglecting the credit profile of the issuing bank means you're neglecting a fundamental vulnerability.
One that can wipe out any perceived structural advantage.
Second, we identified the recent structural shifts, specifically the rise of decrement indices.
Yes. The widespread adoption of decrement indices is a profound operational change. It requires investors to be vigilant about the true source of their yield. Newer products rely less on embedded dividend income and more on this fixed deduction mechanism.
Which fundamentally changes the expectation of relative performance against the physical index.
It does. An investor has to always quantify the annual drag imposed by the decrement index to understand their true effective yield.
And finally, the primary operational value of these complex certificates is tactical, their defensive structures and their ability to facilitate loss recovery.
The recovery strategy framework proves that the engineered payoff structures, the European barriers, the autocall features, they provide an asymmetrical path to accelerate the break-even point for distressed equity positions. That's a goal that's often unachievable just by holding.
And when you combine that with the high-value, quantifiable tax offset advantage,
they transition from speculative instruments to highly valuable strategic tools for active portfolio restructuring and tax loss harvesting.
This analysis really confirms that the complexity of structured products is precisely what creates these opportunities for strategic portfolio management. For the sophisticated investor or advisor, the operational challenge moves away from predicting market direction,
which is impossible,
to the mastery of finding the optimal structural asymmetry. The right mix of high vega exposure, tactical theta decay monetization, and the appropriate delta for hedging. It's about arbitraging the market's specific pricing of volatility and time.
Indeed. And we've confirmed the value added by that tax offset capability, which is often the most significant quantifiable benefit of the whole operation. But for truly rigorous analysis, the next logical step is to quantify the precise value added by that tax benefit against the inherent credit risk in a downturn.
So does the value of the tax loss carry forward outweigh a potential low-probability default event on that senior unsecured note.
Exactly. The structural arbitrage only holds up if the cost of the credit risk premium you're taking on is lower than the quantifiable tax benefit you're realizing. That's the next level of analytical rigor required in this space. It's the final critical check for any successful recovery switch.
A perfect challenge to leave with our listeners as they approach their year-end portfolio adjustments. That was an incredibly dense and useful breakdown. Thank you.
My pleasure.
And thank you for joining us for the deep dive. We'll see you in the next one.